Welcome back to the Deep Dive. We're here to sift through the complex reports and pull out the key insights you need. Today, we're digging into Agnico Eagle Mines. They just dropped their Q3 2025 results, and there's a lot to talk about. Okay, let's unpack this. The headline, absolutely massive. Record-adjusted net income, operations firing on all cylinders, and they are seriously printing money right now. But, and this is where it gets interesting, their costs also jumped quite a bit. So you've got this tension, this paradox almost. Success bringing higher expenses right along with it.
That tension really is the core story of Q3, isn't it? The results look phenomenal on the surface, record profits, record cash flow, all driven by that amazing gold price. But our job here is to look a bit deeper, right? To see the strategy underneath. How did they turn this, well, potentially temporary high price into something more durable for the long haul? So the aha moment we're really hunting for is how a major producer like Agnico Eagle manages this incredible current profitability while at the same time pouring huge amounts of capital back into the ground. And not just for future gold, but also making this pivot, this new venture into critical minerals. It's quite the balancing act they're pulling off.
Definitely. Let's start with the money side, because you mentioned it, the gold price really set the stage this quarter. What was the average realized price they got?
It was huge. $3,476 per ounce in Q3.
Wow. Compared to last year.
Last year, same quarter, it was $2,492. So, I mean, almost $1,000 an ounce higher. That's just an enormous tailwind.
And that flows directly to the bottom line, I assume.
Absolutely. Directly. Record-adjusted net income, $1,085 million. That works out to $2.16 per share.
Yeah.
It's nearly double what they did in Q3 of 2024.
Over $1 billion in adjusted net income?
Yeah.
Incredible. And did the cash follow?
Oh, yeah. The cash followed. Record free cash flow, too, and for working capital changes, $1,035 million just in the quarter. They were just generating piles of cash.
And it wasn't only from mining operations, was it? There was that other transaction.
Right. Good point. They showed some smart financial moves, too. They sold off their shares in Orla Mining Ltd.
How much did that bring in?
That brought in $405 million in cash and resulted in a $271 million gain they recognized. Basically turning an investment into ready cash during a strong market gave them even more financial flexibility.
Okay, so swimming in cash. But now let's circle back to that cost issue you mentioned. Operations running well, but costs are up. Why?
Exactly. That's the bit that needs explaining. You look at the numbers, total cash cost per ounce went up to $994. Last year, it was $921.
And the AISC. That's the big one
yes.
everyone watches.
Right, AISC, the all-in sustaining cost. That jumped too. $4,373 per ounce, up from $1,286.
Maybe just remind folks quickly, what does AISC cover again?
Sure. AISC is meant to be the sort of true cost of mining. It includes your basic cash costs, mining, processing, admin, but crucially, it also includes the sustaining capital. That's the money you have to spend just to maintain production, replace equipment, keep the mine running year after year. It's the full picture.
Got it. So why did both cash costs and this all-in cost go up when gold prices were so high? Seems counterintuitive.
It does, but the reason is actually because the gold price was so high. It boils down to royalties.
Royalties?
Yeah. Most royalty agreements, they're calculated based on the revenue, on the actual price of the metal sold, not just the profit. So when gold shoots up to $3,476,
the royalty payments shoot up right alongside it.
Precisely. It acts like like an automatic tax on that high price. Agnico estimated that royalties alone added about 61 rounds to their costs in Q3.
So the very thing making them rich is also making things more expensive. A constant battle.
It is. It's inherent in the structure of many mining agreements.
Okay, so with costs creeping up like that, are they getting nervous about their full-year guidance?
That's the important question, right? But the answer seems to be no, at least not on the production side. Their operational strength is holding. They reiterated the full-year gold target. 3.3 to 3.5 million ounces. That's solid.
But the cost side?
On the cost side, they're being realistic. They basically said, look, because of these sustained higher royalties driven by the gold price, expect our unit costs, both total cash costs and AISC, to end up towards the top end of the ranges we gave earlier.
So managing expectations there. The volume is secure, but the cost per ounce reflects that royalty reality.
Exactly. They can't control the gold price and therefore can't fully control that royalty component of their costs.
All right, let's shift gears from the financials to what's happening on the ground, because you need that operational excellence to generate all this cash in the first place. Seems like they had some big wins across the portfolio.
Oh, absolutely. Operationally, Q3 was really strong, especially seeing the newer regions scale up effectively. Look at Nunavut.
What happened there?
Records. Meliadine hit record quarterly throughput. That's thanks to really getting the Phase 2 mill expansion dialed in and optimized.
And Meadowbank, also in Nunavut.
Meadowbank, too, yeah. Record throughput there as well. They benefited from processing a lot of ore they'd stockpiled earlier, which helps manage costs, too. It really shows that their big investments in that northern infrastructure are, well, they're paying off.
Okay, Nunavut strong. What about the big Canadian hubs, Ontario and Quebec?
Huge contributions there. Detour Lake in Ontario, I mean, the scale is just immense. They hit a record quarterly mill throughput, almost 80,000 tons per day.
80,000 tons a day. That's consistency.
That's the engine room. And it wasn't just volume. Macassa, also in Ontario, had really strong production, mainly because of fantastic grades. They reported almost 19 grams per ton gold for the quarter.
Wow, 19 grand, that's high grade.
Very high grade. Means more gold for every ton you mine and process. Big impact on efficiency.
And Quebec.
Quebec kept pace. Goldex set another record for quarterly tonnage. That's 2 quarters in a row now. And at Canadian Malartic, the grades they were getting from the Barnat pit were actually better than they'd planned for. So just really solid execution across the board.
That smooth execution obviously provides the cash for reinvestment. And boy, did they reinvest in Q3. The spending numbers on development look huge.
They really opened the taps on future growth. Development capital spending was $316 million, plus another $81 million on capitalized exploration specifically tied to development projects.
So almost $400 million plowed back into the ground in just 3 months. Where's that money primarily going?
A big chunk is focused on their next flagship asset, the Odyssey mine, specifically the East Gouldy Zone, underneath the current Canadian Malartic operations.
That's the big underground project, right? How's that progressing?
It's moving along well. The main shaft sinking resumed, and they got down to 348 meters by the end of the quarter. That keeps the development of the East Gouldy production levels on schedule for first ore in the second half of 2026.
But they made an even bigger decision there, didn't they, about the shaft depth?
They did. And this really shows the long-term thinking. They approved extending that main shaft much deeper, down to 1,870 meters.
Whoa, that's significantly deeper. Why do that now?
It's all about future efficiency. It costs more now, obviously, but it sets them up for much better, more flexible, and likely lower cost mining of the deeper parts of the ore body way out into the 2030s and beyond. It's spending money today to optimize things a decade from now.
Strategic patience. And presumably the exploration results support that kind of investment.
Yeah, the drilling continues to hit good zones. They highlighted one intercept near the planned infrastructure, 4.8 grams per ton gold over about 25 meters. It confirms the value is there, waiting for the development to reach it.
Okay, so Malartic is key. What about other major development pushes? Detour Lake.
Yep, Detour Lake is another focus. They're pushing the exploration ramp deeper underground there, advanced it another 259 meters in the quarter. The goal is to get a bulk sample from what they call the West Extension Zone, probably in the first half of 2027, confirming those deeper, potentially higher grade zones.
And Hope Bay up in Nunavut. Still investing there too.
Definitely. Hope Bay is about getting the site ready for a potential future restart or expansion. They finished key infrastructure upgrades like expanding the jetty, which is critical for efficient shipping in the Arctic.
Makes sense.
And they had a little unexpected bonus there, too. While dismantling parts of the old unused mill,
They found gold.
recovered about 2,442 ounces just from the cleanup. Nice little windfall. And exploration drilling there is also looking promising, particularly around the Madrid Patch 7 zone.
Okay, so we've got record profits flowing in, huge reinvestment into core gold projects for the long term. Now, let's talk financial strategy again. How did they use that massive cash flow on the balance sheet itself?
This is where you see really disciplined capital allocation. They didn't just let the cash pile up. They immediately went and paid down debt. $400 million of long-term debt repaid in the quarter.
Took it straight off the books.
Straight off. So you combine that debt reduction with the $1 billion in free cash flow generated, and their net cash position just soared. They ended September with almost $2.2 billion in net cash.
$2.2 billion. That's a war chest.
Yeah.
Up significantly from the previous quarter, right?
Hugely significant jump, yeah. Up from $963 million just 3 months earlier.
And that kind of financial strength gets noticed, doesn't it?
It absolutely does. Moody's saw this strengthening and upgraded Agnico Eagle's long-term issuer rating to A3 with a stable outlook.
What does that mean in practical terms?
It means they're now considered solidly investment grade. That generally lowers the cost of any future borrowing, makes them more attractive to certain investors, and just underlines their financial stability. That's a big stamp of approval.
And having that incredibly strong balance sheet, that foundation,
Yeah.
presumably gives them the confidence to make major strategic moves, like launching this new thing, Avenir Minerals Limited.
Exactly. This Avenir launch is arguably the biggest strategic development in the report. It's a really forward-looking move.
Tell us what it is.
Okay, so Avenir Minerals is a new, basically standalone subsidiary. Its entire focus is going to be on evaluating and advancing critical mineral projects. So think things other than gold or copper, like lithium, nickel, rare earths, whatever might be needed for the energy transition. Initially, they're focusing just within Canada.
And Agnico Eagle is funding it.
Yes, they're seeding it with about $80 million worth of existing critical mineral investments they already held, plus injecting $50 million in cash to get it started.
Now, why create a whole separate company for this? Why not just have a critical minerals division within Agnico Eagle?
That's the key strategic question. The structure is designed, really, for focus. By setting up Avenir as independent and self-sustaining, it allows the main Agnico Eagle management team to keep their laser focus on running the global gold operations, which is complex enough.
Right, keep the core business clean.
Exactly. Meanwhile, Avenir is free to pursue these critical mineral opportunities, which might have different timelines, different risk profiles, maybe need different expertise, without distracting from the core gold business. It's about creating options, diversifying strategically, but doing it in a way that protects the main engine.
Okay, so wrapping up Q3 2025 for Agnico Eagle.
Yeah.
It feels like it was defined by these two really powerful, almost opposing forces. First, you had the windfall profits from that sky-high gold price.
Which immediately triggered higher costs, especially through those royalties.
Yeah.
The paradox we talked about.
Right, and second, you had this incredibly aggressive, very targeted deployment of all that cash, pouring hundreds of millions back into securing long-term gold production, like that super deep Odyssey shaft.
And simultaneously making this big strategic bet on diversification into a whole new area with Avenir Minerals.
So thinking about the listener, what's the key takeaway here? What does this report really tell us about Agnico Eagle and maybe the wider industry?
Well, I think for you, the learner, it shows a company that's absolutely refusing to just ride the wave of high prices passively. They're using this period of exceptional financial strength very actively, very strategically. They're locking in their future in gold by making these huge long-term infrastructure investments now, even if it means accepting some higher near-term costs. And they're looking beyond gold, positioning themselves for future resource needs with Avenir. It's proactive management in a volatile market.
Okay, and as always, we like to end with a provocative thought, something to mull over. What's sticking with you from this deep dive?
For me, it comes back to Avenir. Think about the long game here. If gold prices stay high, great. Agnico's core business is secured and thriving. But what if gold prices pull back eventually, as they often do? By planting this seed now in critical minerals, a sector driven by massive global trends like decarbonization and geopolitical supply chain security, how much value could Avenir realistically create outside of the gold market? Could this move, funded by today's gold boom, fundamentally reshape Agnico Eagle's identity over the next decade or so, from just a gold major to something broader? That potential transformation, that diversification play, that's the really fascinating thread to watch going forward.